Welcome back to Investing Talk Podcast.
Today we're looking at WhiteFiber.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For anyone who's been tracking the AI infrastructure space, WhiteFiber just had a huge moment. When we look at everything, it all comes back to this massive, decade-long contract they just landed. This isn't just a piece of news. It's really the definitive core of the bull case for the company.
Okay, so let's unpack that deal because it really needs some context. We're talking about a company that, essentially rents out these super high-powered rooms for the AI revolution. So what's the scope here? Who is the customer?
The customer is InScale, a major player in the hyperscaler world. And the deal is for their NC1 colocation facility. It's an $865 million 10-year contract.
Wow.
Yeah. And if you just do the quick math on that, it translates directly to guaranteed revenue of about $86.5 million a year. A year, starting in April 2026.
So $865 million over 10 years sounds huge, but, in a world with giants like Equinix or Digital Realty who report in the billions, is $86 million a year really transformative? How does that actually move the needle for a company WhiteFiber's size?
It's all about scale and timing. I mean, for a company with an enterprise value sitting around $400 million,
right,
locking in $86.5 million a year from one single blue chip client for a whole decade is it's absolutely game-changing. It validates their entire pivot into AI infrastructure.
So it proves the model works.
It proves the model works, and it de-risks their long-term revenue almost instantly. It's not a guess anymore. It's a locked-in stream of cash.
And something that really stood out to me in the details was the protection they built in against, economic uncertainty. I'm talking about the pricing.
Exactly. This isn't just a flat rate. They got long-term contracts that include 3% annual escalators.
Which is huge.
It's critical. We've all seen inflation, especially for power and cooling, which are just massive, massive expenses for data centers. That 3% escalator locks in good pricing for them, and it hedges against their own costs going up. It shows they have some serious negotiating power right now.
Well, if you're running a huge AI model, you need that stability, right? Knowing your costs are predictable for a decade. So that brings me back to the competition. We talk about the giants all the time. How does landing one big customer like Nasdaq suddenly create a competitive moat for WhiteFiber?
It's all about credibility. It creates instant credibility and real barriers to entry.
Okay.
For years, WhiteFiber was just another player in cloud services. Now they've proven they can execute these really complex high-density builds fast enough to win a massive contract against global competition. That validates everything.
So when Nasdaq signs on, it's like signal to everyone else.
Precisely. It tells every other hyperscaler that WhiteFiber can deliver the quality and, crucially, the speed that modern AI compute demands.
That makes a lot of sense, the credibility and the revenue safety net. Okay, so let's pivot from that 10-year vision to the balance sheet right now, because this is where the story gets a little tricky, and it's probably why the stock has been so volatile. You've got this aggressive growth on one side, but real liquidity pressure on the other.
The growth story is, it's undeniably strong. You look at the Q3 2025 results, total revenue was $20.2 million.
And that's up how much?
It's a huge 65% jump year over year. Their main engine, the cloud services part, grew 48%. So the demand is clearly there.
But, and this is the big but, they missed their Q3 earnings estimates. They posted a net loss of $15.8 million. So when a company is growing revenue by 65%, why is it still posting a loss that spooks investors?
Right, and that loss really needs context. It wasn't because of a failure in their operations or, lack of demand. The analysis shows that the loss was mostly because of significant post-IPO expenses.
And what does post-IPO expenses actually mean, in plain English? For someone just learning about this stuff, that can sound kind of vague.
Sure. Think of it like the cost of growing up in public. When you go public, your audit costs explode, regulatory stuff gets way more expensive, you hire new executives.
Right, lawyers, bankers.
All of it. These are mostly one-time or temporary costs that make the loss look bigger than the underlying business would suggest. It's not about the health of the data center business itself.
Okay, that's helpful. But the more urgent issue, which ties into funding all this growth, is the actual cash they have on hand. What's the liquidity picture look like?
And that is the true short-term hurdle. As of the end of Q3, the company had about $166.5 million in cash.
Which sounds like a lot of money.
It is. But
Yeah.
given how much money it takes to build out these facilities for Nescale and others, analysts figure that's a runway of less than a year.
Oof.
Yeah,
Yeah.
they're in that classic high-growth crunch. The spending is outpacing the cash coming in for now.
So they have this amazing guaranteed future revenue stream, but they have to get the financing to actually build the buildings to get that revenue. What's the plan to fix this?
The whole plan centers on one critical event, and it's expected very soon, in early Q1 2026, the closing of a construction credit facility.
So a loan to build.
Essentially, yes. And what makes everyone more comfortable is that this loan is backed by a dedicated $150 million equity commitment, specifically for the NC1 project.
So the financing is kind of de-risked because the bank knows the contract with Nasdaq is already signed. They know the money is coming.
Exactly. It turns a risk into more of a timing issue. If that credit facility closes like everyone expects, the market should immediately price out that short-term liquidity fear.
Let's go back to the competition, but more on the tech side of things. How is WhiteFiber standing out technically? What's their unique value prop?
Their whole moat is built on two things,
Hmm.
density and speed. They've perfected a specialized retrofit model.
A retrofit model.
Right. Instead of building a data center from an empty patch of dirt, that's greenfield construction, they take existing buildings and they rapidly convert them into these high-density AI data centers.
Can you give us an analogy for that? What's the difference in time and complexity?
Sure, think of greenfield, like building a custom mansion from scratch. It takes 3 to 5 years, permits, zoning, all of it. A retrofit is like taking an old warehouse and turning it into luxury lofts. The shell is already there. You just focus on the high-tech interior, the power, the cooling. It can cut the deployment time in half.
And the density part, when you say high density, what does that actually mean?
It means they can handle extreme power and heat. They're building to a Tier 3 equivalent design, which is a very high standard. And more importantly, they offer 150 kilowatts per cabinet.
150. And a normal cabinet is what?
A standard cabinet might use 5, maybe 10 kilowatts. So this is a night and day difference. It's the kind of power you need to run dozens of the most powerful AI chips in a single rack.
That's an incredible difference.
It is. And all that power creates insane heat, so you have to be efficient. That brings us to PUE, or power usage effectiveness. WhiteFiber is targeting a PUE of 1.3 or better.
Okay, you've got to break down PUE for us. Why is 1.3 a good number?
Absolutely. So PUE is the ratio of the total energy a data center uses compared to the energy that actually powers the computers. A PUE of 2.0 means for every watt powering a server, another watt is wasted on cooling and lights.
Got it.
A PUE of 1.3 means for every 100 watts powering the AI, only 30 watts are used for everything else. For a massive customer like Nescale, that efficiency directly saves them millions on their electricity bills, a huge selling point.
So the secret weapon is that they can deliver these specialized, high-power, super efficient data centers faster than anyone else. They're filling a shortage.
That's it, exactly. The infrastructure shortage is driving this whole AI spending boom, and WhiteFiber is set up to capitalize on it quicker than the traditional builders.
This all sounds very bullish for the future, but the stock price today seems to be stuck on that Q3 loss and the liquidity risk. How should we think about the current valuation?
The consensus suggests the stock is fundamentally oversold right now. The volatility from that earnings miss has created a pretty big valuation gap compared to its peers. WhiteFiber's enterprise value is sitting around $427 million,
Okay.
and it's trading at about 11 times its estimated 2026 EBITDA.
Let's break that down. If EBITDA, what's the simple way for our audience to think about that?
Just think of it as how many years of operating profit it would take for the company to pay off its entire price tag, including its debt. It's a standard way to compare companies. And WhiteFiber is at 11 times.
And where are the big established peers trading?
But they're typically in the mid-teens, 14, 15 times. So there's a strong case to be made that if WhiteFiber just executes on this NC1 plan, its valuation multiple could expand dramatically just to catch up. That's the recovery opportunity.
And that explains the aggressive price targets from analysts we're seeing. What kind of upside are they talking about?
I mean, they're overwhelmingly bullish. You see H.C. Wainwright with a $34 target, which is over 100% upside. Even B. Riley, who cut their target a bit, still has it at $40, which implies, what, 127% upside? Yeah. The consensus is pretty firm in that $32 to $38 range.
That's a strong signal. Are we seeing any institutional money, any smart money buying into this story?
We are. The stock jumped 9% right after the N-scale news, And there have been reports of unusual call option buying, which some people see as a bet on a sharp upward move. We also saw that Prelude Capital took a $258,000 position back in Q3, so they were getting in early.
So it looks like the market noise is maybe hiding a really strong fundamental catalyst that the big players are starting to notice. So let's look ahead. What are the key events to watch over the next 3 months?
The calendar is packed. First, and this is the most critical, is the closing of that construction credit facility. That's expected very early in Q1 2026. If that closes, the biggest risk is gone.
And then the next report card.
That would be the Q4 2025 results expected in early March 2026. The expectation is for a revenue beat, showing that ramp-up in colocation is already happening.
And then the big one, the payoff.
The payoff. The third key date is April 2026. That's when the NC1 Phase 1 billing starts. That is the day the $86.5 million annual revenue stream officially turns on.
We also heard some chatter, maybe speculative, about an expansion of that facility. Anything to that?
It is speculative,
Hmm.
but given Nscale's needs, it's a key long-term possibility. There's potential for an expansion that could double the deployment size by late 2027, so the current deal might just be Phase 1.
All right, let's wrap up with the bear case. We talked about liquidity risk, which the financing should solve. If that comes through, what's the biggest risk left on the table?
It really comes down to just two things. First is execution risk. Can they actually deliver this complex build-out on time? And second is a broader slowdown in cloud services. But that Nscale deal really cushions that second risk. The demand is locked in for a decade. The bear case is now less about the market and more about WhiteFiber's ability to manage the construction. So to sum it all up, WhiteFiber really looks like an asymmetric recovery play right now. You've got the stability of that locked-in $865 million AI revenue stream, putting a floor on the valuation, but the stock is trading at a deep discount to its peers.
A huge discount.
A huge discount. The 65% revenue growth plus the new capital coming in puts them on a path to start generating real free cash flow by mid-2026, all driven by this AI boom.
That is a fantastic breakdown. Before we go, here's a final thought for you to chew on. Considering the macro environment, how will sustained interest rate stability affect these highly leveraged growth models like WhiteFiber's across the entire AI infrastructure industry?
A critical question for any company building big things quickly.
Absolutely. Thank you for joining us for this analysis. Be sure to hit that subscribe button so you don't miss our next one.